Breaking news. As of this afternoon, the Bank of England rate has gone down. So what does that mean? Hi, we're going to be talking about the Bank of England rate, the swap rate, and how it relates to you first-time buyers. Now, my name is Amanda. I am the mortgage coach because I combine mortgage advice with financial coaching. So let's jump in. First, what is the Bank of England rate? So the Bank of England rate is the base rate or the interest rate that the Bank of England sets. A long while ago, the government gave the Bank of England independence. And what that means is it's the Bank of England rate influenced by the government, but it is that Bank of England rate that sets what the interest rate is. Now, what that means is, depending on whether you've got a mortgage, whether you're saving, whether you're getting personal loans or credit cards, this is all affected by the interest rate. So what you've got is you've got the principal, that is the amount that you are borrowing, and then in order for the bank to make money, because everyone's a business, they charge interest, and that's what we're talking about, the interest that is charged. Now, back in COVID days, the interest rate was only about 1%. So if you borrow 100,000, for example, say it's a mortgage, then you're only paying 1% of that, which obviously is only 1,000. But then if the interest rate went up to 6-7%, which it did, at the moment it's gone down from 5.25 down to 5. So now you are paying 5% on that 100k, so £5,000. I hope that makes sense. If you've got any questions in the please put them in the comments and I'll explain it in a bit more detail. Now, if you're enjoying this video and you think it's useful, please subscribe to my channel and click that notification button so you know when more useful videos are coming up. If this particular video is really making sense and you're finding it informative, please click the like button and also share it with others. Now, what next? So now that the Bank of England rate has gone down slightly, that, as I said, will affect mortgages. Now, there are several different types of mortgage. There is the fixed rate. Now, with the fixed rate, what the banks normally do is they look at what the Bank of England rate do and they make a decision based on that. So it is influenced by the Bank of England rate. Now, if you've got a tracker rate, that correlates exactly with the Bank of England rate. So what I mean by that is you might have a tracker that is a plus 1%. So what that would mean is when the Bank of England rate was 1%, you would pay plus 1%, so you pay 2%. When the Bank of England rate is 5%, like it is today as of this recording, you pay 6%. So it's very good if you think the Bank of England rate is going down, because then every single quarter it gets reviewed, then you can actually see that what you're having to pay goes down. Unfortunately though, it literally does track the Bank of England rate. So if the Bank of England rate goes up, which it has been doing for the last couple of years, then obviously you will also have to pay more. So that's the pros and cons of being a tracker. If you've got the fixed rate, you might be fixed at say 5%, and then if the rate goes down to 3 or 4, you're still fixed at that 5%. But if the rate goes up to 6 or 7, then you're still fixed at that 5%. So it depends what you think the market is going to do. Now, the other thing I mentioned is savings. Now, with the rates going down, it may mean that they decrease the rate that they put for your savings. This is why a lot of people invest their money in stocks and shares or buying other property like buy to let, because they can make money from that. With savings, you don't always make as much money as you used to. So that's one thing. If the Bank of England goes down, the savings, the rate that you get for your savings. So this is like the opposite of borrowing. So if you've got 100k of savings, that'd be nice, wouldn't it? But if you did, then the interest that you get paid on that would be, either the 4 or 5% or whatever the bank deems to be a good savings interest rate compared to the Bank of England rate. The next thing to look at is loans and credit cards. Now, they are also influenced by the Bank of England rate. I say influenced because, again, the lenders are built banks and building societies. They will actually look at what it's actually costing them, and they'll look at the Bank of England rate, and that will influence what they do. Now, when I say costing them, what used to happen back in the day, the way banks used to work were, what would happen is you would actually borrow money from savings. What I mean by that is, what would happen is a bank would come along, and everybody would start, opening savings accounts, and they'd be putting their savings in there. And then what the bank decided to do was actually borrow that money from the client and actually lend it out to people. And then that way, the money is being used, the money is earning money, it's earning interest, and then some of that interest gets paid over to the clients that are actually saving. So that's how they can afford to pay interest on savings, because they charge interest on borrowing, but it's the exact same money that they were using. But then what happened was, less people were saving, or they weren't able to save as much as they used to, or they were diversifying, like I mentioned before, getting buy-to-lets, investment properties, or investing in buying businesses, or stocks and shares. There's a lot of things that, or crypto. There's a lot of things that you can do with your money nowadays. You don't just have to put it into a savings account. So they were doing different things. So then the banks were like, we don't have enough money. A lot of clients are coming to us now, and they're saying that they want to borrow, X, Y, and Z, but we don't have that much money. So they would go to the swap market. So now the swap rate. So also, what is going on in the market, that's why I've brought it up, is the swap rate is going down. Now, the Bank of England rate is going down, the swap rate is also going down. What the swap rate is how, when banks are trying to borrow money off each other, it's the interest rate that's being charged. That's called the swap rate. As that goes down, it means it's cheaper for the lenders, banks and building societies, to borrow money. So some of them will pass that savings on to the client. At the end of the day, it makes sense for banks and building societies to be competitive. So if a couple of other banks have dropped their rates because they can borrow at a lower rate, then other lenders will follow suit because they also want to get that business. At the end of the day, myself as a mortgage advisor, I'm always sourcing the best deal for someone. So when I look, not only do I look at the interest rate, I look at the percentage, the loan to value, and then I also look at what the deal is costing in total. So that's the interest rate plus the actual arrangement fee, product fee, booking fee, whatever you want to call it. Some lenders will give a really, low rate, like I've seen some rates like at 3.94, but then you're paying £7,000, £8,000, £9,000 for that deal. So it doesn't overall work out to be the cheapest. Sometimes you're better off with a 4.5 rate with no fee than a 3.9 rate with a massive fee. I hope that makes sense. I hope you've enjoyed this video. I just wanted to come on and say, it's really, really great news that the Bank of England rate has gone down, and I hope that it continues. And other things that it influences, it can influence inflation. What I mean by that, so basically, when it comes to inflation, that's how much things cost. Again, if you're enjoying this video, please subscribe and share. Now, with inflation, it does look at how much things, goods and services cost. And when inflation is high, goods and services cost more. Now, inflation can go down when the interest rates have gone down, because normally when interest rates go down, it means that more people are less likely to save because they don't get as much interest on their savings, but they are likely to borrow. When interest rates go down, first-time buyers are like, right, I'm going to buy now. Home movers are like, right, I'm going to move from a 2-bed to a house and things like that, the remortgages, people are like, okay, I want to remortgage now, maybe do a bit of additional borrowing so I can consolidate debt, so I can make improvements on my home, so I can possibly buy a car, buy a business, you know. It does help the economy. That's another thing. It gives consumer confidence for them to go out and do more. Now, the other thing is it also affects, as I've kind of already mentioned, investment. It encourages people to do more investment. And then the last thing is exchange rates. If the Bank of England rate, it can affect the value of the pound. Now, depending on whether the value of the pound is strong or weak compared to the euro or the dollar or the yen, can really, really make a difference. If you can get more for your pound, then obviously it gives you more spending power abroad. So no, not only, you know, are the interest rates low over here and you're able to spend more, then if your pound is stronger, then you can also invest abroad. So I hope that has made sense. If, as I said, if you've got any questions, please, please, please comment in the chat, and I will, by all means, I answer all the comments. If you've got any ideas for any videos that you'd like to know more about mortgage and money matters, that's great. But as I said, it's great that the interest rate has gone down from 5.25 to 5%, and that's of the 1st of August 2024. Thank you.